to do a little introduction, Rick, and then we'll get started for real.
Right.
Let me make this full screen, and in fact, I might. Yeah. Okay. Good. So, thanks very much, Rick, for
sorry about that.
joining us. Yeah. No.
I was watching a little World Cup soccer and lost track of the time.
Okay. No worries. So, we have a group of about, I don't know, maybe about 8 or 10 of us here, which is a little
Great.
smaller than I expected. But it's the diehards of the diehards, I guess, because being June, maybe more people are on vacation or something. So
I hope it's not the speaker.
it's definitely not you, because I'm quite confident people want it to you. So
Okay, thanks.
I'll just kind of get us started here. I want to let everybody know that, kind of with Rick's permission, this is going to be recorded, but the recording is not going to be distributed. I'm not posting it online anywhere. The reason I'm doing it is because when I do these, kind of organize these events, I'm kind of thinking about, does everybody have enough OJ and M&Ms? And is the technical working? And people coming and going. And by the time it's all said and done, I forgot everything we talked about. So what happens is, probably tonight or the next night, I'll sit down with a cocktail or a beer, and I'm going to fire this up and watch it again, and I could actually learn something from it.
Okay.
So that's why I'm recording, to let you know, but it won't be posted. A little background on...
It's fine with me if you want to post it. I'm okay with that.
Oh, okay. Yeah, thank you.
Up to you.
Thank you, Rick. Yeah. So a little background on Rick. Most of you probably already know something about him, but I'll just read a short little bio that I found. Most of this came off of Amazon, although I updated part of it based on your ADV Part 2.
Okay.
So Rick Ferri is the founder of Portfolio Solutions LLC, a low-fee investment advisory firm based in Troy, Michigan. Portfolio Solutions manages approximately $1.3 billion in separately managed accounts for high-net-worth individuals, families, nonprofit organizations, and corporate pension plans. The firm specializes in analyzing and using low-cost and tax-efficient index funds and ETFs to build wealth for clients. Another feature about Rick you may have all observed is that he is one of the most prolific posters on the Bogleheads forums, and he has given us a wealth of advice just through that channel, in addition to his books. Mr. Ferri earned a Bachelor of Science degree in Business Administration from the University of Rhode Island and a Master of Science degree in Finance from Walsh College. He also holds the designation of Chartered Financial Analyst, or CFA. Prior to joining the investment community in 1988, Rick served as an officer and jet pilot in the U.S. Marine Corps and is now retired from the Marine Corps Reserve.
Retired. See, retired.
Yes. Okay. Rick is also the author of a number of investing books. And by the way, I'm just going to I'm going to make you small for a moment and bring up the website for Semper Fi, which this is another fabulous feature about Rick, which is that all these books that he's written, he donates, he keeps none of the profits and donates 100% of the profits to this Semper Fi fund, which is used to help out our hardworking military families. So that is awesome, and thank you very much for that, Rick.
Sure.
So, okay, now let me go back to you, as opposed to the Semper Fi website. Okay. So as far as books, he's written at least 7 of them that I'm aware of. So the Bogleheads, he's a co-author of this Bogleheads Guide to Retirement Planning.
More like an editor.
Or an editor. And all about index funds, which is personally one of my absolute favorites. This one, I believe, came out in 2006.
Yeah, that's the second edition.
This came out a few years later, the second edition, but it's timeless advice. And it's one of the ones that in my own seminars is right up there. And I advise my clients to go to the library, pick this up in a true Boglehead fashion, to get it from the library if possible.
Of course. The only problem with that book is Vanguard keeps changing their indexes.
Yeah. Yeah, so the underlying index could change, yeah, but the principles...
The concept is the same, yeah.
The principles exactly the same.
Right.
So this is awesome.
Thanks.
Okay, here's another book, The Power of Passive Investing, and you will observe there's a lot of post-it notes. I'm using this to try and influence retirement planning committees to do the right thing, which a lot of times I've observed they're brainwashed. But I find this to be an invaluable resource, The Power of Passive Investing. The ETF book is one that I just finished up over my summer vacation.
You did, huh? Wow.
Yeah, even though it was
you must have insomnia or something.
Yeah, it took me a few years to get to it because it came out about 5 years ago. But yeah, that's a nice one. Thank you. And this is another goodie all about asset allocation. So, and then the two that I don't have, but at least one of these is a PDF on the web, which you give away to everybody, is Serious Money, Straight Talk About Investing for Retirement, which was way back in 2000, Protecting Your Wealth in Good Times and Bad in 2003 you published. So Rick, thank you very much for your books and for all your posts and for serving our country in the military as well as in the investing arena, which is helpful to all of us. Now, kind of with that introduction, I'd like to kind of get started with the real meat of today, which is the Q&A with Rick. So we're going to, since we kind of have the laptop here in beautiful downtown Durham, North Carolina, in this co-working space.
Okay.
And I have you projected onto the screen. It's not as bright as I wish it would be, but I got a pretty big image of you on the wall. What I've asked people to do is, I'm going to be sitting here next to the computer, and when you're talking, I'm going to mute us. And then, of course, I'll unmute us when we're talking. I'm just going to ask people, after I kick us off with the first question, then after that, people will come up and kind of ask questions. I'll ask them to sit right down here and look at you. So so that way you can feel more natural in that way. So as far as the first, another thing, I just want to have a reminder that Rick is he's a wealth of knowledge to help us build wealth. And as far as asking questions, I would suggest that you keep it to general investing questions.
Yeah.
There's tons of investing questions you can ask, but if you ask the question of like, I'm 62 years old and I'm wondering, should I dump my REIT fund? I'll answer it right now for Rick. The answer is, it depends. And it depends cannot be answered on this. If it's a specific about your needs, your specific need, what I'm going to ask you is call Rick's company. Go to portfoliosolutions.com, find the number, and talk to a helpful person on the other end, and they can help you answer that question. But if it's a general investing question, Rick's totally the man, and we should cover it today.
What I tell people is, because I get this all the time, is I'm not allowed to give individual investing advice because it's the SEC requirement that if I'm going to give people individual investment advice, I then become liable because I'm in the profession of for what you do. So even if you don't pay me. So I ask people, instead of saying, I'm 62 years old, should I dump my refund, my REIT fund, you could phrase the question to, if a person was 62 years old and getting into retirement and they had a REIT fund, do you think they should keep it? So it's a general question as opposed to a question about you. And then I can answer it.
Good. Hypothetically speaking.
Suppose this hypothetical person, but anyway.
Okay, good. Thank you.
That's how I give legal advice these days.
Legal advice could be done the same way. Okay, from the retired attorney at law. So, okay. So, great. Thank you, Rick. So my question to kind of start us off, and then we'll open it to the floor, is I wonder if you could share kind of two-part question, I guess. One is, are there any updates on your recent research, kind of what you're working on now or what things we might expect if you're writing another book or so on that's upcoming, and also just more generally, is there anything on your mind that you think you would like to share with this group?
Well, there's a lot of things.
Okay.
Okay, so what am I working on? Big projects. I am working on a book. Bill Bernstein's got me beat out, though. He keeps putting out these little ebooks. I haven't even put one out yet, but I'm working on one. I just changed the title of it to The Education of an Index Investor. What I want to do is what Bill has done, Bill Bernstein, is put out a 100-page ebook that talks about how you become an index investor. And I've thought about this from many different angles, and thought that the best way of doing it is to, for lack of a better way, to tell my story about how I became an index investor, and then relate that to my concepts of 3 different parts of becoming a successful index investor. And they are, people who have heard me speak before probably heard me talk about this, but there's the aha moment, the philosophy, the change of religion that occurs. And that occurs generally through education. So you start questioning the concepts of active management or whatever it is you're doing. You start getting an education. And then at some point, may take a year, may be slow like me, may take more years, but you have this epiphany, you have this aha moment where everything, the clouds clear, and you just get it. Yeah, it just comes to you. I see it. And so the education of an index investor starts out with having this aha moment. Once you have this aha moment, the next thing now is you're very motivated to move forward into creating a portfolio for yourself based on your needs. So you start absorbing information about asset allocation and the types of funds that are out there. So the next part of this is a strategy. So you're going to develop a strategy for yourself. And there's no answer. Everybody has their own strategy. We all have the same philosophy. We're all in the same church, but we all have different strategies. You talked about the fellow who's 62 and has REITs. Well, there might be another fellow who's 62 who owns a couple of houses and doesn't want REITs because he already has exposure to real estate some other way. So the strategy that you're going to implement is going to be different. You might use a 3-fund portfolio. You might use a 4-fund portfolio. You might use a tilting to small cap value, and all these other different strategies. But whatever it is, you're going to develop your strategy. The next thing is implementation of that strategy somehow in your portfolio and actually getting it fully implemented. But the third big phase of it is once you get it implemented is the discipline to stick with the strategy. And the way you stick with the strategy is through continued education, such as what you're doing right now is a good example of continued education. So if you follow this diagram all the way around, this Venn diagram, it starts out with education to get the epiphany, to get the aha moment, then researching index funds and asset allocation to come up with the second part, which is strategy. Then implementing the strategy in a portfolio. And then the hardest part of this whole thing is the third part, which is the discipline to stick with it. John Bogle says, stay the course, stay the course. And the way that you stay the course is through continuing education. So it becomes this circle of reinforcement. And in the middle of the circle, if you do it all correctly, is a successful index investor. So that's the whole idea behind the education of an index investor, which is I'm trying to condense all this down to a 100-page ebook so that it can be widely disseminated. And that's what I'm working on now. Now, quite frankly, the smaller the book, the more effort it takes. The ETF book, which is almost 400 pages long, in fact, I think it is 400 pages long, where you write everything down and you put everything in there about ETFs and you cover all these different topics. That's actually an easier book to write, even though it's 400 pages long. To try to condense these ideas down to 60, 70, 80 pages and get the point across in a simple way is actually much more difficult. So It actually is taking more time to write this simple book. So that's one thing I'm working on. Another thing I'm working on is a white paper on rebalancing. A lot of people have questions about rebalancing. There's been some good studies done on it. Bill Bernstein did a study several years ago on rebalancing. And all I want to do there is show, we talk about rebalancing. People always ask, when should I rebalance? How should I rebalance? And I think that before you can get into that discussion, if you really want to understand rebalancing, you really have to understand the dynamics behind when rebalancing works well and when rebalancing is just okay. It doesn't really work that great. And it has to do with the varying correlations between asset classes. It has to do with the volatility of the asset classes. It has to do with the performance of the different asset classes. And these things are always changing. So you could look at a time period and you could say, gee, rebalancing worked really well during this time period if I did it annually. But then you could look at another time period, it actually hurts you to do rebalancing annually. And so you're saying, gee, it hurt me there, it helped me there, what's going on here, when's the ideal time to rebalance? And I think that in order to try to get past the confusion about rebalancing, you have to first dig into what drives successful rebalancing, and that's what this paper is going to be about. Again, it's been done before. I'm just going to try to write it in a way that is more presentable. The papers that are out there, a lot of them are PhD level, and they're all very good. And I'm not going to be breaking any new ground here, but it's just a matter of taking the concepts and making them into plain English so that people can say, oh, I get it. Oh, I see. Okay. I see why rebalancing didn't work that great here, but it has worked much better during the last 10 years than it did the previous 10 years, things like that. So that's what a paper that I'm working on right now.
Rick, thanks very much for that. But I can relate the third part of the first part of your answer along with rebalancing. In other words, discipline and rebalancing are really easy. No, I won't say they're easy to write about, but they can be written about. They're easy to read about, I should say.
Easy to read about.
But it is hard, really hard, I would say, in certain circumstances to have discipline. For example, if it was February or March of 2009, that's a hard time to be disciplined, right? So how could people really take that to heart and do the right thing? I mean, it'd be easy to do the wrong thing in March of 2009, in other words.
Well, there's two things you can do. The easy thing is to buy a life strategy fund where it's going to be done for you and you have no choice. And you just keep putting the same money into the same fund and don't worry about it. I mean, that's the easy solution. So when you're talking about my little diagram of aha moment, strategy, and then discipline, the way you can implement your strategy is through just a life strategy fund. And that stays disciplined for you. So you don't have to do anything. Another way is hiring a money manager. Whether it's if you have enough money, you go out and you hire somebody who can give you personal advice. But there are other programs online now that like Wealthfront and Betterment and these other online robo-advisors, we call them, that they'll do the rebalancing for you at a nominal fee. So that can keep you disciplined that way, because you don't have to do the rebalancing. Somebody else is. If you're going to actually do the rebalancing yourself, that is the most difficult way, because now your biggest enemy is yourself. I see that people don't do it. They delay doing it. Money comes in, they don't implement it. They'll say, well, let's just wait a little while and see where the market. They do all of these behavioral finance things that actually hurt them. And so I'm all a believer for doing automatic rebalancing in some way where somebody else does it, whether it's the computer that does it for you or you do it yourself. Now, ironically, in the United States, we are handicapped. And I say we're handicapped because there's a SEC regulation that says that you just can't go out and go to Vanguard and put the money in the mutual funds that you want using the asset allocation that you want, and then have Vanguard automatically rebalance it for you under a computer model, and that not cost you anything. Because the SEC says that if a company such as Vanguard is going to do this for you at no cost, they are actually taking discretion over your portfolio and responsibility over your portfolio, and therefore there's all kinds of regulations about know your client and so forth. Now, I just came back from Europe. I was speaking in Europe, and that rule doesn't exist in Europe. So the brokerage firms in Europe, some of them, that are doing indexing and ETFs, you can actually buy your ETFs or buy your index funds. They call them trackers in Europe. They don't call them index funds. You can buy your portfolio, and then you can tell your brokerage firm, anytime it gets out of these parameters, I want you to automatically rebalance, and there's no cost to doing that. So in a way, they're one up on us in Europe. Here in the United States, because of regulation, you can't do that. So it actually makes it more difficult. You either have to pay for it in the United States, or you have to do it yourself. So, or you use a life strategy fund. But to get to the more deeper question of 2008, 2009, even if you were doing a life strategy fund, or even if you had an asset allocation that was being rebalanced for you, question is, are you able to hang in there during the worst, darkest times in the market? Or are you going to sell that life strategy fund because it's down 30% and it's only 50% in stocks, and you're looking at your retirement account going down, 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 and you're looking at 2 years before retirement or something, and you're getting very nervous? And the answer to that is much more psychological. It has to do with, did you have the right asset allocation in your portfolio going into the bear market? And that's a real tough question, because in times like right now, where the market went up 30% last year and it's up about 4 or 5% this year, people tend to be brave in a bull market. So they tend to, if you ask them back in 2007, so Steve, what do you think you should have in an asset allocation? You think you can handle 70% stock? You say, oh yeah, no problem. No, I can do that. Macho. Everybody's brave in a bull market. So you tend, at times like this, where the market's going up a lot, you tend to over-allocate to equity, or think that you should. You tend to do these things. And you only find out that you're wrong and that you've over-allocated or, quote-unquote, over-leveraged yourself to equities emotionally during a bear market. So you really have to work at what really can I handle? Now, I think a lot of people learned in 2008, 2009 what they can really handle. So the people who capitulated and sold are really at a disadvantage, because I just wrote an article, blog about this, unintentional market timing. If you capitulate and you sell in the beginning of 2009 when the market's down, the chances are you're not going to get back in. So you not only made one mistake by being too much equity and then selling at the bottom, now you made a second mistake, because now you're out of the market and the market goes up 100%. So it really hurts you very badly. And so it's really important for investors right at the beginning to have an asset allocation that is not only technically correct, mathematically based on the risk and return that you're trying to achieve in your portfolio, but it's behaviorally correct based on what it is you intend, you may or may do in the next bear market. If you hesitate on rebalancing, if you hesitated on rebalancing in 2009, you probably didn't have the right asset allocation. You probably had too much in equity. If you capitulated, you certainly did. But even if you hesitated, you really have to consider, can I really handle this? So it's much more, it's the easiest thing to talk about or write about, the hardest thing to actually do. Long-winded answer, sorry.
That's great. Great feedback, though, and I think in the beginning you said it's in the head. Yeah,
it's all in the head. It's all in your head,
or maybe the heart, or the gut, or the stomach, or something.
Or whatever. It's all in.
Well, thank you. I'm gonna move to the side a little, bring the chair over, and invite somebody else from the group if somebody else wants to come up and ask Rick a question. Looks like we got Tony.
Tony, okay.
So
Hello, Rick.
let's make sure
really,
you're in there.
I haven't been too exposed to your readings, but in preparation for this meeting, I was very impressed with the depth of your homework. You've done all kinds of good stuff. Appreciate that. Thank you.
Yeah.
I ran across your blog, your discussion about the total economy portfolio, and that's kind of a cool idea. I was wondering if you could talk in general about the international version of that model, and then how it might compare and contrast to a traditional international kind of portfolio.
Can I first talk about what the concept was behind the economic portfolio? And I guess that would be the way to begin. So we have the economy, and we have the industries that make up the economy. And then you have the stock market. And the stock market is just a way for some of these corporations to capitalize, to get the money they need to run their businesses, to capitalize. So the question then becomes, if you analyze the economy and what makes up the industries in the economy, and you analyze the stock market, you realize they're two different things. The stock market doesn't quite reflect the economy. There's a lot of portions of the stock market that are that overemphasize certain industries relative to the economy. And there's a lot of industries in the stock market that are very, very small in the market, but are very, very large in the economy. And so let's look at one. Let's look at real estate. Real estate as a percentage of GDP is probably, commercial real estate, something like 13-14%. But if you look at the stock market, commercial real estate is only 3% of the stock market that has been collateralized in real estate investment trust. So right away, you've got 10% of the stock market is off from the economy. So it gives you an idea of, if I wanted to have my portfolio look more like the economy rather than the stock market, what would I have to do? And let me preface this with, I did research on earnings, the earnings in the stock market versus earnings, national earnings in the economy, and the earnings in the economy are much smoother than the earnings in the stock market. So you say, well, if I was to develop a portfolio that looked more like the economy than the stock market, since the earnings in the economy are smoother, perhaps the volatility of my portfolio and the risk-return relationship of my portfolio would actually be a smoother ride. And in fact, that's what happened. So you first start out by saying, okay, I need more real estate in my portfolio to get my portfolio looking more like the economy, so I'm going to add 10% in REITs. There you go. So now your portfolio is looking more like the economy from REITs. But then you look at the economy and you realize that more than 50% of the economy is small, medium-sized businesses that are not reflected in the stock market. These businesses tend to have valuations that are lower PE type valuations in the private market than what trades in the stock market. So I did a lot of analysis to determine what section of the stock market could I magnify, which would have what looks as close as you can to the private business market, which makes up half the economy. And it turns out that when you're looking at private equity funds that specialize in small cap, and particularly small cap value type companies, the performance of those private equity funds the performance of those private equity funds look a lot like small cap value stocks in the market as far as the correlations. So you say, okay, so what if I took a bigger position to small cap value stocks? If you did that and you put that in your portfolio as well, so you have REITs and you have maybe a 30% position in small cap value, so you're magnifying that part of the stock market, now you're getting your portfolio closer to what the economy looks like and what national earnings look like as far as an earnings stream and volatility of earnings than what the stock market looks like. So it's a way of backing into It's a way of backing into a portfolio that actually ends up looking like a Fama French portfolio in a different sort of a way. But I mean, it's sort of just a way of justifying having these tilts in your portfolio that give you actually, have given you, I don't like to say give you, I say have given you a higher risk-adjusted return. Now to your question about international, you're really asking, well, since the U.S. is only 45% of the stock market, is only 45% of the capitalization of the global equity market, should we be moving our portfolios more towards higher international? Well, quite frankly, from a GDP perspective, the United States is only 27% of the global GDP. So if you were going to use the idea of the global economy, then you would even move your portfolio even less towards the U.S. and even more towards international, particularly towards emerging markets. So you'd have this big position in emerging markets, and you'd have a position in developed markets, and then you'd have like a 27% position in the U.S. Is that the type of portfolio you would want, though? And the answer is probably not, because we have to pay our bills in U.S. dollars. And so we have this home country bias. You could do that. You could take that position, that large position in emerging markets of about 50%, and then 25% in developed markets and 25% in U.S. markets, and that would look like the economy, the global economy. But boy, you'd have a really volatile portfolio, and the question becomes whether or not you want to have that. I don't know if I answered all your questions, but there you go.
I got to remember to unmute when people speak from this side.
That was great. I mean, you are very lucid in the way you explain things. So thank you very much for that. I think.
Well, honestly, this is not. I didn't make this stuff up. I mean, this is.
Yeah, sure.
All I try to do is break it down into usable level.
You pack it together really well, so it's understandable.
That's right, thanks.
So basically, the issue tends to turn on the tracking error issues for a person living in the U.S. with a portfolio like that, and certainly if you had like 50% in emerging market, I mean the tracking area would be huge. I mean,
huge.
It would just be.
And can you handle it? Can you handle that kind of a tracking error when emerging markets at times do
go just
very
nuts.
bad?
Right, just go nuts. Right. And
how long can you hang in there with this portfolio? So everything in moderation. That's what I like to tell people.
Yeah.
If you're going to go to a tilt to small cap value and some portion in REITs, if you look at the actual data and you did an efficient frontier on REITs versus the rest of the stock market, you'd say, well, why don't we put 50% of our portfolio in REITs? And the answer is, you don't want to do that, because their tracking error would be so large, and REITs could underperform for such a long period of time. Okay. How long can you hang in there with that portfolio? And the answer is generally 2 to 3 years, and then you're out.
Yeah, I absolutely agree.
Out at the wrong time, probably.
Yeah, right.
You're out at the wrong time, and you've shot yourself in the foot, because now you've underperformed, and now you're lost in space out there, and you're like, what do I do next? Right. And you end up going with the next hot thing. So my belief on all of these things, like putting REITs in a portfolio, putting small cap in a portfolio, putting emerging markets in a portfolio, is do everything in moderation. Don't deviate so much from the return of the market that your portfolio could be off so much that it starts bothering you so much that you say, I got to make a change. Because if it does, you should have never done it to begin with.
I see. Very good. All right, that's good. All right, I'll move on to the next person. That's good. Thank you.
Yep, thanks. Good luck.
Who's next with a question for Rick?
I think you're beginning to see that everything I'm talking about here is more.
Oh, I think we got a question from Jim coming in.
Okay.
Well, I don't have a question, but I'm Jim Kelly, and
Hi, Jim. Hey.
I'd just like to thank you for everything you've done for investors, myself, and my colleagues.
Oh, well, thank you, Jim. I appreciate everything you've done. Appreciate it very much. Good to see you.
Thank you.
So have you guys met before?
Yeah, well, I know who Jim is.
Yeah, okay. Excellent. Nobody hopped up right at this moment, so I'm going to take advantage. Wait, who took my questions? Tony. I was like, give me back those questions.
Okay.
All right, this is not necessarily strictly a nuts and bolts question, but I'm really curious to understand more if you'd be willing to share. You mentioned before about the aha moment is one of the first steps, right? And you described, or your bio describes, how in 1988 you joined the finance world, and then at a certain point, I know you switched over to indexed, more passively managed approach. And I'd like to understand if you could share a little about that experience with us of your own aha moment and how you switched from what I would consider the dark side to the more appropriate approach, which is passively managed or indexed. I'd love to hear more if you'd be willing to share.
Well, I'm a slow learner.
Okay.
Well, it took me a while.
I don't believe that part. But.
Well, it's true. It's true. So, okay, I'll try to make this short. When I left the Marine Corps active duty, I got a job as a broker working at Kidder Peabody, which is one of the ones that fell by the wayside during one of the financial crises that we had. Anyway, and you know, you go into the brokerage industry and it's all about selling products, but it's not presented that way as a broker. As a broker, the way it's presented to you is you're really smart and you can figure out which are the good funds to buy, which are the good stocks to buy, and which are the lousy ones. And this is framed this way to you when you go through your training. But in reality, the way the brokerage industry works is they don't care what you sell as long as you sell something. That's a high commission. They don't care if one guy in the office is selling General Motors and the other guy in the office is buying General Motors. I mean, they couldn't care less. What they care about is transaction, turnover, okay? But they try to make you believe that you are an investment advisor. You have no training whatsoever. You have no education in this, and you go to a 3-week school and you walk out of there thinking that you're Warren Buffett, and you're not. In fact, you can go to seminars that do technical analysis that try to sell you technical analysis programs. You see them on TV. And it's the same thing. You go to a weekend course and you walk out of there thinking you're, Warren Buffett, and you're not. So anyway, I mean, that's the way the brokerage industry is working, because they don't really want you to know that you don't know anything, because then you lose your confidence. But what I did was, once I came out of broker training, I started using the products, selling the products, but I also kept track of the performance. And I started using money management companies to manage my clients' equity portfolios, and I managed their individual bond portfolios myself in a bond ladder. I thought that made sense. But I started monitoring the performance and created this computer program that monitored the performance of the equity managers that I had chosen. And I created benchmarks. And this stuff is off-the-shelf software now. We have Morningstar, we have this, and we have that. But back then, we didn't have much, so I created it. And my company actually thought that I had some special knowledge. They put me on the committee at Kidder Peabody to select money managers for Kidder Peabody's money management wrap fee program. So I was one of the 5 people from the offices that was brought into New York, and they would do a dog and pony show and bring all these managers through, and they would show us how great they were. And one of the guys who was on this committee was a quantitative analyst who was a CFA, and I was working on my financial analyst designation at the time. And he was showing me all the quantitative analysis that he was doing on these money managers to determine whether or not they're actually any good or not. And it was called attribution analysis, a very deep attribution analysis. I thought this stuff was great because it really dug down into whether or not this manager was good or not. But what he was telling me was, most of these managers are crap, but we have to pick some. The company wants us to pick some of these managers, and the brokers will only sell the managers that have just done really well. So even though my data is showing that these managers are just, lucky, and that they're not really skilled, we still have to put the managers in the program. So we pick the managers generally that have done well over the last few years, knowing that they're going to blow up and that we're going to be adding new managers later on. He's telling me this. So I said, well, if you will know all this, I mean, why are we doing this? And he goes, because that's our job, right? So anyway, short story long. So I'm using these managers and I'm picking these managers and putting my clients' money in these managers and I'm monitoring these managers based on a computer program that I designed based on the information that this fellow showed me, quantitative. And I'm realizing that he's right. I mean, these managers are just, it's random whether or not they outperform or not. And net of fees, most of them didn't outperform. And then they blew up. And then the managers who were very popular got a lot of money and then they started managing money differently and then they blew up. I mean, it was just this mess. And this went on for 3 years, and I switched firms, and I went to Smith Barney, and they were supposed to have a better analysis program to determine which money managers were good, which was bad. I'm sorry I'm drawing this whole thing out. But again, working on all this for many years.
Don't be sorry. This is fascinating to me to hear the story.
Right. Yeah. Okay. All right. So I'm just getting very frustrated saying, there really is no way to pick a manager who's going to outperform in the future. Most of it's randomness. And if it's not randomness, if it's skill, the manager's goals are different than my goals. The manager wants to start managing billions and billions of dollars. And my goal is, look, I just want you to manage a little bit of money and I want you to manage my clients' money. And so you can get the returns that you'll be getting. So the whole thing was all messed up. And very frustrating. And around 1996, of course, I was working on my CFA at the I had my CFA at the time, and I was working on my master's of science and finance. And I kept seeing this book at the library because I was an avid reader of every single investment book that was printed. I mean, I read everything. And I kept seeing this book pop up on the bookshelves, Bogle on mutual funds. Bogle on mutual funds, excuse me. And I knew who John Bogle was, and I knew indexing, and I heard John Bogle speak at a conference, and he made a lot of sense. So I said, I'm going to buy his book. So I remember reading his book, and this is kind of a funny story, and I've told it before. It was October 26th, 1996. And I took my kids to one of these House of Horrors, okay? They were in teenagers or preteens, and they were going to go through the House of Horrors. And so I drop them off in the House of Horrors, and I go and I park in the parking lot, and I'm just waiting for them to go through and screaming and whatnot you're hearing in the background, and chainsaws and all this other stuff. And I'm reading Jack Bogle's book. And he's telling me exactly what I am feeling. Exactly what I am seeing. And I was like, I started, like I said, screaming and yelling in my own car, even though the House of Horrors is over there. I said, this is so true. This is it. And it was like a chemical reaction. I mean, I can't describe it any other way. It was a complete, the light came on. And it was, the clouds cleared, and I got it. I mean, I understood. And that's what I meant by, the aha moment. And then after that, I just dedicated my career towards doing that. Now, it took me a couple of years to set up a company and to get out of Smith Barney because I had taken upfront money, and that's the way it happens in the brokerage industry. When you move from one company to another, they give you all of this money, and I redid the kitchen, and we took a trip with the kids, and we bought a pop-up camper. I spent the money. Well, not all of it, but if I would have left right then, I would have had to pay it back. But I said, I'm going to take these next few years, 2007, 2008, 2009, when I still had this contract, and I'm going to really study this stuff. I'm going to really understand it. I'm going to create a company that does this, and I'm going to go out and do this. But I have to say, in all fairness to Smith Barney, I had a meeting with Jamie Dimon, who was my boss. And Jamie Dimon now is the CEO of JP Morgan. So I'm talking with Jamie, and he was very approachable, and he's just like he is on television, and very straightforward. And I said to Jamie, I want to create a program within Smith Barney. And this is what I want to do. I want to use all index funds from Vanguard. And I just want to do an asset allocation of index funds using Vanguard funds, and I want to charge our clients 0.5% per year. I want to create this within Smith Barney. Jamie didn't take that very well. In fact, I won't say what he said to me, but it had to do with the fact that more than anything, that the philosophy was fine. He didn't care. They don't care what you sell. They don't care as long as the company makes money. And he basically said to me, that idea is not in our shareholders' best interest at Smith Barney. We have other mutual fund companies that are paying us a lot of money to distribute their product. They'll pay us a bunch of money every year to be on our platform, in the $250,000 to $500,000. Vanguard won't give us a dime. They won't give us any 12B1 fees, and so we're not gonna do it with them.
Now he was obligated to act in that capacity, right? Because he's got a responsibility to his shareholders.
That's exactly right, and the same thing now. Where he works now is the same thing. So I understood that, and then but in all fairness, because I said I'm not going to go do this until I have this conversation, and I went right to the top. I had the conversation with Jamie. I said, then I'm leaving, and I'm going to start it myself. And he basically said, if I were you and you really believe that, I would do the same thing. And so for the next couple of years, I just worked on that. And when my contract was over at Smith Barney, I started my own company to do just this. And that's it. That's the story.
I'm really psyched that you did that, and I'm sure all your clients are as well. So yeah.
Oh.
Did Jamie himself believe what he was saying?
Oh, okay. So Henry asks, did Jamie himself believe, in what he was doing or what you were doing? What did Jamie really believe himself? He
didn't tell me what he really believed. It wasn't his role to tell me what he personally was investing in. Although I have to tell you that I have a lot of clients who are former Wall Street executives that this is what they believe. I found through my years in this industry, and it's been more than 25 years now, that you start talking heart to heart to the top people in the industry at these different firms, and I'm talking about the CEOs of Merrill Lynch, and I mean the top people. What they do with their personal money is index funds. Well, they might have some token money here and there, but if you get them aside and you bring them, you buy them a couple of drinks and you start talking about index funds and ETFs, and you find out real quickly that their personal money, they're not doing what they're selling. Their money is tucked away in the kinds of products that we're buying, and a lot of them are using Vanguard, strangely enough. So,
Is that right?
Yeah, I think that's a really good question. If somebody goes to work with you, if they hired you as an investment advisor, or if they hire a broker or whoever they work with, if they choose to work with somebody, go ahead and ask that question. Are you investing in all of these things that you're recommending to me or not? And if not, why not? And it'd be really illuminating to understand the answer to that question. My hope is the answer should be, yes, I am in most, if not all of them, and I've got a perfectly good reason because my circumstance is different than yours, that I might not be the same.
Well, yeah, your strategy, again, the philosophy has to be the same.
Yeah, exactly.
Again, we're getting back to the three keys here, right? The three things that make an index investor successful. The philosophy is there. We all have the same philosophy, okay? Strategy-wise, we're all probably going to have different strategies. I remember being at the Boglehead conference last year, and I asked the question, I said, how many people here are Bogleheads? Of course, everybody raised their hand, right? Because they're all Bogleheads, they're all at the conference. And I said, so all believe in low fees and this and that and the other and so forth. I said, how many people in this audience have the exact same asset allocation and portfolio as somebody else in this audience? No one raised their hand. Nobody.
Yeah, right.
So that's the difference between strategy, philosophy and strategy. And I say is that we're all here about philosophy. We're also here to help each other build the right strategy that's for them. But don't think that there's one strategy that fits all, because there isn't. And I think that the next phase of just in my business is much more customization than we've been doing in the past, because it's needed. And so for my own business at Portfolio Solutions over the next couple of years, I think you'll be seeing me change our business model a little bit to do some model portfolios. Well, you have a choice. You can pick model portfolios, but do more customization. The software is available to do it, and you can do it, relatively inexpensive. And for people who have substantial amount of money, who have stock options and they have restricted stock, or they have something going on where they're a lot of their human capital is in one particular industry, like healthcare or whatever, you would want to create a custom portfolio for them rather than doing a model. And so that's the next, I think, phase of my company. And so then again, that's strategy. So the strategy is going to be different for everybody. The philosophy is the same. The strategy is different.
Great. Thank you very much, Rick. That was fascinating to hear that
good.
background. And I kind of had a feeling it was going to be something along those lines, but I hadn't really seen it described before to that level. So hearing it directly from the source is great. And I think since we were talking, Tony's got one and Henry's got one, and John has one. So I'm going to put you last, Tony, since you already had a chance. And would you like to come first? Sure. Okay. So it's Rob. Yeah. Okay, Rob. So we got 3 on the queue so far, and here is Rob.
Hey, look, I've got plenty of time, so however long it takes.
Hey, Rick. I just wanted to start off saying that I am a fan of your books, and back in 2008, there was a number of articles in the Wall Street Journal, and they were talking about what's really in your asset allocated mutual fund. And so I started digging into my own portfolio, looking into it, and I got extremely frustrated. And that's when I came across your index fund book. And within about a 4-week period, I went through your index fund book, your passive allocation, and your ETF book. And so I just wanted to say thank you.
Can I stop you for a second there? I just want to say that generally, the people who have that aha moment, which you had, just have this they just develop this incredible appetite to devour knowledge and devour books. And to me, that's one of the signs that you have the philosophy, that the light has come on. If I talk with people who haven't done that, they say, oh yeah, index funds, I've heard about them, so what kind of a portfolio should I have? I can't go to what kind of a strategy you should have, because I'm not yet convinced that you have the philosophy yet. So it's really, what you just told me tells me that you've done what you need to do to have the philosophy. And so now then you can move to strategy. So I just wanted to jump in on that.
Sure.
Sorry.
And part of my frustration at the end of 2008, by then I'd already been doing lazy portfolios for about a 5-year period.
Okay.
And just kind of everything in 2008 kind of fell apart. And things didn't quite
Why
make
did they
sense.
fall apart?
They just didn't track, based on the, the different indexes, they just didn't seem to track right. And so things seemed really out of whack. And again, with those Wall Street Journal articles, it just made a lot more sense of what was really going on. So anyways, I just wanted to say thank you to that. My question today is, though, part of my strategy includes global, excluding U.S. aggregate bond funds. And some of my frustrations with that is they're still fairly high fees.
Yes.
What's your feeling on including that as part of your bond fund strategy?
Okay, I don't have international bonds in my portfolio. Bonds are not like stocks. You buy bonds for the income. Can you get enough diversification in a U.S. bond portfolio to get the income? And the answer is yeah. You're using the total bond market, using a couple of other funds together. You've got thousands of bonds that are providing income. It's not like you're going to get capital appreciation from bonds. I mean, if interest rates go down, okay, you'll get some capital appreciation, but pretty much across the globe, interest rates come down. Now, I'm not against having international bonds in my portfolio if the cost was the same as having U.S. bonds in my portfolio, but it's not. It's 3 times higher. Even at Vanguard, it's 3 times higher. If you look at the International Bond Fund, even though the expense ratio with the Vanguard International Bond Fund is relatively low, I believe it's below 20 basis points, you have to double that because of the currency hedging that they do in the portfolio. You have to pay for currency hedging. And I talked to Ken Volpert, who I talk with all the time. He's the head of fixed income at Vanguard. And he told me that the hedging cost is around 12 basis points in that fund. So you add the hedging cost into the higher expense ratio, and you really wiped out any diversification advantage of having that fund in your portfolio. And I wrote about this in All About Asset Allocation, the second edition. About, makes sense. This is one of those things where it makes sense in theory, but it doesn't make sense in practice to have it. It just hasn't provided a real benefit to investors. So again, getting down into the strategy here, the philosophy is if you're going to use international bonds, fine, do it through Vanguard in a low-cost way. Do you need it in your strategy? I tend to believe you don't, because you can get enough diversification in the U.S. bond market, get that income coming in, get that diversification from equities. You don't need to go international. But if you decide that you do want to do it, and it's really splitting hairs one way or the other, it's not going to make much difference in your portfolio return or the risk, then using the Vanguard fund is fine because it's low cost. There is a much stronger argument for using emerging market bonds in a portfolio rather than developed market bonds. 2 reasons why the Vanguard Emerging Market Bond Fund is interesting, more interesting than the developed market the International Bond Fund. And the first reason is because there's no hedging cost. And the reason why there's no hedging cost is because Vanguard only buys emerging market bonds that are issued in US dollars. So different companies in different countries will come to the US and issue their bonds in the US. And so it's already, you don't have the extra expense of currency overlay. So that's a good thing. The second thing is the yields, of course, are higher than developed market bonds. So it's a little bit of a diversification or a substitute from high yield bonds. So if you had a high yield bond in your fund in your portfolio, which I use the Vanguard High Yield Corporate Bond Fund in my portfolio, you could make the case of saying, well, instead of having, if your portfolio is 100% fixed income and 20% is in high yield U.S. corporate bonds, you could make the case of saying, well, I might actually split that in half and put 10% in U.S. high yield corporate bonds and 10% in the Vanguard Emerging Market Bond Fund. You could make that argument. I haven't done that, but you could. So, again, it gets to that strategy portion. I have this saying about slicing the blueberry pie. You have this blueberry pie, and every time you cut the pie, you leave more blueberries on the plate, and less goes into your stomach. So if you take a portfolio and you start diversifying and diversifying and diversify it into 15, 20 different funds, all you're doing is leaving more blueberries on the plate. You're not actually getting any more nutrition from the pie. And in fact, you're getting less. So you can go too far with this stuff. I've seen portfolios that have 50 different mutual funds in it. Well, all you do is you've got a very messy pie plate, and a whole lot of stuff left on the plate. Because it's you just keep cutting that pie, cutting it and cutting it and cutting it, and you're just creating more and more cost. So that's how I look at some of these things. I sort of take it all in, saying, what do I really need? to get the job done. What is really that different than something else? And that's how I make my decision. So I hope that answered your question.
My next question kind of goes along the same lines, that if you're looking at a strategy of a certain percentage being international funds.
In bonds or stocks?
Well, that's what I'm about to ask.
Oh,
is that
okay.
Should you also include that that percentage of allocation? Should you also consider the bonds, international bond funds, as part of your international percentage?
Yeah, so again, most of the bond funds that you run into, and particularly the Vanguard fund, is dollar denominated. It's hedged in U.S. dollars. So you're not getting international exposure from Vanguard international bond funds because either the emerging market fund is issued in U.S. dollars or your hedging currencies. So you would have to go outside of Vanguard to actually get an unhedged international bond fund. I think PIMCO might have one, but it's not cheap, like 50 basis points or something. And in that case, the answer is, if you were to do that, then yeah, probably you would include your international bonds as part of your international allocation. But then again, I only use 30% international equity, which is unhedged. So if you look at my international equity in a 50-50 portfolio of stocks and bonds, it's only 15% of my portfolio is hedged out of US dollars. To some extent. The other part of that is what John Bogle always talks about, which is that more than 40% of earnings of U.S. large cap corporations come from overseas, and they have currency exposure over there. So if you look at like a Gillette or something, it's mostly overseas sales. And so my answer is to your question is, if you're going to use an international bond fund that is unhedged, yeah, you probably want to consider that as part of your international allocation. But if you're using only Vanguard funds, it's not going to be an issue because it's all U.S. dollars anyway. Is that an answer for you?
There it is. Yeah. Yes, it does. Thank you.
And by the way, this is all strategy now. So I mean, if you want to do it, do it. Whatever's right for you is right for you. Just maintain it. The idea of strategy is discipline. So whatever strategy you come up with, if you want to have more, if you want to use international bonds, if you want to use emerging market bonds, whatever it is, whatever strategy you come up with, the real important thing is maintaining it for a long period of time. That's what makes it work. If you come up with a strategy and then keep changing the strategy, then you don't have the philosophy. You see, you got to go back here again.
Thank you.
Henry, you had a question before. I wonder. Yeah. You kind of stuck your hand up, but. Yeah. Okay, so this is a retired attorney, Henry, also serious distance runner, I think.
Well, used to be before I got old and creaky.
Have you been to a Boglehead reunion?
I have not, but I monitor the blogs and stuff online sometimes. So, and I've been a Boglehead disciple for about 25 years now.
Oh, so, wow, you're way beyond me.
Well, and it's interesting you talk about the behavioral stuff. I got a real clear sense of my over-allocation to equity in 2008 and 2009, and so I've adjusted since that time. Had two questions, Rick. I was reading some of your blogs online, and the one on your asset allocation as between taxable and tax-exempt funds, I thought was interesting how you went through the conventional wisdom of having your equities that are throwing off the capital gains in taxable accounts and right. Your bonds and such that throwing off a lot of income in your tax-exempt accounts, and then you were saying, but then there's some circumstances where if you need liquidity, you may want to mix that up some and have your asset allocation be consistent both within and without your taxable and tax-exempt accounts. But for liquidity, are there other reasons why you might recommend going in that direction?
Yeah, somebody actually put this on Bogleheads after I posted that blog, and it said they ran into some problems. I think it might have been a financial advisor who wrote this, or a financial planner. They said, my clients were doing asset location, and she ended up in her personal account and her IRA account with all of the stuff that didn't do well, and he ended up with all the stuff that did well, and they got divorced. And it was a real problem. I thought about that, and I said, you're right, that if a husband and a wife are managing the household assets together, and she has an IRA rollover that's quite substantial, and he doesn't, or whatever. I mean, you could get into a situation where a divorce makes it blatantly apparent that you should have had the same allocation in all portfolios, because the discrepancies can get very large. So it was another reason I thought that was a good, interesting. So this is probably one of the most difficult questions there is under the strategy umbrella, strategy pot of money, taxes. I'll start out by saying that taxes should be the second thing you worry about. The first thing that you should worry about is the right asset allocation overall. You can't manage your accounts forever based on taxes, because eventually you're going to somebody's going to pay, whether it's you or the next generation. So if you can't decide, you kind of default back to, well, what's easy, and what should I be doing from an asset allocation perspective? The big problem with taxes is that we never know what Washington is going to do. We don't know what the tax code is going to be in the future. We could load up our portfolio, our taxable portfolio, with all equity, and our IRA portfolio with all bonds. And the next thing you know, Washington changes the tax code on capital gains and dividends, and we just shot ourselves in the butt, which they have. And then they could change this. They change the strategy on IRA distributions in order to get people to spend more money. They might say everybody's going to get the first $50,000 a year, withdrawn from their IRA tax free or something. I mean, we just don't know what they're going to do. So it makes it very difficult. And then individually, once we retire, unless you've got a pension coming in from a corporation, if you're a retired attorney, you can control where you take your distributions from. Between age 59 and a half and 70 and a half, that 11-year period of time, you've got great control over whether or not you're going to be taking money out of your IRA, or whether you take it out of your Roth, or your personal account. I mean, you can really work on tax planning and really control your taxes to, when should I sell this piece of real estate? If I sell this piece of real estate, then I won't take any money out of my IRA that year, and then the next year I will take a bunch of money out of my IRA because I'm not going to have any income. I mean, you can do all these things. So it makes the whole idea of tax location much more difficult. And so that's why I wrote that article, and that's why I talk about it. I mean, in concept, tax location is a great idea. Mm-hmm. Let your equities, which are you have lower capital gains and lower dividends, put all your equity in your personal account and put all your bonds in your IRA, and that might work pretty good for a few years until you run into the problems that it creates later on. Yeah. And then you sit there and you say, "Why did I do that?" All of a sudden, you find that you need $200,000, $300,000 for something. Yeah. And you're looking at your personal account and you're saying, I got to get it out of my personal account, but my gosh, everything's at such a low tax basis. Not only am I going to get slammed because I have to take all capital gains, but now it's affecting everything else in my taxes. All of a sudden I have less deductions that I can take on my itemized deductions, and my Social Security all of a sudden becomes more taxable. And so I think we all, with this tax location strategy, need to think beyond how it's going to help us today to how it might hurt us later on, and that's why I'm trying to get this other information out.
Yeah, I've been thinking about that as a person sees the age of required minimum distributions looming on a horizon that's only medium term, not long term anymore. And then you start thinking, all right, well, I'm going to have to then start paying it back. And so that's one of the things that I was thinking about in looking at the location of where you put the assets.
Yeah, absolutely. And you know, if you start looking at people are going to be living into their 90s, and you look at the actuarial tables for the IRS and the required minimum distribution for people who are in their 90s from their IRA account, holy smokes, are people going to get walloped in taxes? I mean, you have a couple of $1 million IRA, and you're trying to not take a lot of money out during your 50s and 60s, and if that thing grows and you're in your 80s, and you have to start taking out 13, 14, 15, 20% of your IRA every year, and you've got a couple of $1 million in there, all of a sudden you shoot straight up to the absolute highest tax bracket, and it wipes out any other advantages. So tax planning, I think, is underrated in the investment industry, and I think that we in the investment industry, spend a lot of time on asset allocation strategies and, the philosophy in the asset allocation. But, taxes are getting to be a bigger and bigger portion of this whole discussion.
Right.
And I think that critical age between 59 and a half and 70 and a half, where people like yourself are, retiring, I think you really got to spend a lot of time. In fact, you could almost write a book on 59 and a half to 79 and a half, how to use this period of time to optimize your portfolio for, after tax. Because doing a rollover of IRA assets into a Roth IRA in years when you're not going to have any income, or you can arrange that period of time where you have no income, so you take a big distribution from your IRA, more than your required minimum distribution, and then you roll the excess of your required minimum distribution into a Roth IRA. These are really good strategies to do. And I think that the discussion needs to talk more about that. But you can only do it during this period of time between, well, you can do it after 70 and a half, but it's a good question that you have.
Yeah, I have discussions with friends all the time in that age cohort, and I'm always trying to convince folks, every year you ought to be maximizing your Roth conversion without screwing up your tax bracket.
Yes, absolutely.
And I can't believe the amount of pushback I get from folks who don't want to bite the bullet and pay a little bit of taxes at a low marginal rate now.
Right.
They just keep the head in the sand and avoid the long-term crap they're going to have to deal with. Changing subjects altogether for a minute, for those of us who are, we got the philosophy, we're kind of committed to the index investing, and having been burned enough times over the years to see behaviorally where we need to have the allocation, this may be a little bit, kind of a lob here, but what are the reasons really? Is there a need to have a financial advisor to pay, even if the fees you're paying are relatively modest, if you have a certain kind of advisor, versus just handling it yourself? You don't pay any fees if you can force yourself to have the discipline to do what you need to do.
Sure.
What do you think?
Oh, I think that you use a financial advisor or a financial planner when you need one. So, like they have the Garrett Planning Network, you have CPAs out there, you have other folks. And, if you're perfectly fine doing it yourself and you're disciplined and you know what your risk tolerance is and you know what your asset allocation should be based on your situation, and you have the philosophy, then, you just pay for it as you need it. I hire myself. I'm not an expert on health insurance. I don't know if anybody's an expert on health insurance, but so I'm a retired military, and I can do the military medical program, but I'm not 60 yet, so I can't actually get part of my medical paid for yet. So I have to pay for my own medical. So, for instance, I don't want to sit there and try to figure this stuff out. So I hired a financial planner, And, I paid him a few $100s, and he helped me helped me and my wife sort out what was available to us and come up with the best policy at the best price, and sent me a bill just like an attorney would. Mm-hmm. I paid the bill. And so I think that's the way to do it. I mean, financial advisors like me and my company, I say, exist for a couple of reasons. Number one, because a lot of people don't have the patience or the knowledge to come up with the strategy that they need, and then more so, the discipline to stick with it. Mm-hmm. They need someone, or they should have someone to do it for them, because number one, they just don't feel like dealing with it. And a lot of people like that. I mean, you're all a special group because you're very interested. You're here on a Saturday morning. I mean, but you're a very small minority of the general population.
That's a polite way.
We don't know other people like us unless we come here.
A polite way of saying we're a weird bunch.
Yeah.
No, it's just that. Well, I'm here too, so. You hear the term a majority of people should have a financial advisor, and that's because a majority of people are not here in this room today. Yeah, they should, and having the right financial advisor certainly helps. But as somebody who gets it, somebody who believes they have the right asset allocation, you just need occasional work here or there. Let's say you decide, when should I take my Social Security? Should I wait until my full retirement age? Shall I wait till I'm 70 and a half? Should I take it early? When should my wife take it? What if I took it and I wanted to pay it back so that I get a better payout later on? All of these things take some analysis. You may not know how to do the analysis, or you may not want to do the analysis. So you find a financial planner who charges you by the hour, who is knowledgeable about this, and you sit down with them and you pay them $500 or maybe even $1,000 to spend 3-4 hours with you, and you get the answers you want. And just like an attorney, I mean, you can appreciate that because you're an attorney. I mean, that's the same thing. Mm-hmm. And that's what I feel people like a lot of the Bogleheads should be doing.
One final question.
But anybody else, they should use an advisor. So gotcha. I'm not going to discount myself that much. Go ahead.
One final question. What do you think about the role of annuities? Mm-hmm. The conventional wisdom is there can be a benefit in terms of longevity risk, sure, and in terms of covering core expenses, recurring expenses, but that's about it. Yeah. Have any thoughts or insights for the group on? Is that something? Any other aspects to it?
I think that the annuities we're talking about are single premium immediate annuities.
Yes.
Yes.
None of the variable crap.
No. You put $100,000 in and you get out, $7,000 a year for the rest of your life.
Yes.
Okay. So it's a pension. I mean, you've just taken a portion of your IRA money, let's say, or your personal money, and you created a fixed pension out of it. And you can even do inflation adjusted through Vanguard. Mm-hmm. And so the way I look at it is, okay, so you've been putting money into a 401k because the company that you worked for didn't provide a defined benefit pension plan. So you're putting money in a 401k. 40 years ago, there was no 401k. You might have been saving money on the side, and the company's putting money into a pension for you, and you're going to get a pension. So it's really 6 of one, half dozen of the other. You just create your own pension, and if you feel more comfortable with that, with covering your basic expenses through income from Social Security, income from a single premium immediate annuity, maybe you've got a small pension or two that's providing income, and you want to get all your real basic expenses or some of your basic expenses paid for, maybe half of your basic expenses paid for by these continuing streams of income, I have no problem with that. You got to shop around and get the best rate. And of course, it's all based on interest rates, and interest rates are relatively low now. So, but And they're all, of course, based on life expectancy, and there's many different types. You can do joint survivor. You can do certain 20 years certain. In case you died, your heirs would get it. So you pay for all these bells and whistles. But I'm fine with it if this is what you want to do. Personally, for my own account, I don't need to do that because I'm going to be getting a military pension. I've got a couple of small pensions from other areas that are coming in. Plus, I'm just going to be taking 4% or so from my IRA account as a distribution at some point, and I think I'll be fine with that. It also depends, by the way, on how much money you have. Mm-hmm. If you've got more than enough money to live happily for the rest of your life, and your kids are going to inherit some money later on because you've got $5 million and you're only spending $100,000 a year, well, that's only 2%. You don't need an immediate annuity because you're never going to spend the money that you have. So I don't see the benefit to you. So I look at immediate annuities more for people who are kind of right on the edge, right there where just maybe have enough to retire. In my opinion, a single premium immediate annuity probably is more helpful to those people than it is to people who have much more than they're ever going to need. So it all gets down to that, what Steve said, it depends.
Yep. Thank you. Makes a lot of sense.
Exactly.
Thank you. Sure.
That's the default answer. I've practiced that over the years. What do I do about it depends? Let's talk in my office later. All right. Now there was another question from John. I think. I think we have time. If I won't take off any points if anybody leaves early. And Rick, if you have to leave, we can wind it up.
Well, why don't you just set a time of say 11:30, so we have 10 more minutes.
Yeah, 10 more minutes. So John, why don't you come on up? This is great so far.
Okay, great. Thank you.
Hey, Rick. My name's John. And,
hey, John.
I'm trying to get smarter on ETFs.
EFTs?
What?
Oh, no, I'm only kidding with you.
I thought I had it right. And I understand one of the main differences between an ETF and a mutual fund is that the ETF trades all day long.
That's correct.
But I think for most of us here that subscribe to a Boglehead portfolio that we're not trading rapidly or frequently, whether I buy an ETF and I get a price at 11 in the morning versus a mutual fund and I get a price at 4 in the afternoon,
sure.
Who cares?
Who cares? Right.
And it's not like we're going to be trading it the next day. So where do you think ETFs would fit into a Boglehead portfolio?
Yeah, okay, so ETFs are, bear with me, ETFs are a pipeline or a delivery platform for a portfolio. So you'll have a portfolio of stocks or bonds or something, and the portfolio company, whether it be Vanguard or PIMCO or Fidelity, or it doesn't matter, they have these portfolios that they want to deliver to people. And that's how and then they collect management fees from that. So the delivery mechanisms are, you can go to a mutual fund, you can go to a privately managed account, you can do an exchange traded fund. So these are just delivery mechanisms. So the question then becomes, you have to look at the benefits, the drawbacks, the advantages and the disadvantages of the way the product is delivered to you. And ETFs are delivered through the exchange. You have to have a brokerage account to buy and sell ETFs. So right there, if you're a Vanguard investor, you don't need any ETFs because you don't really want a brokerage account, in my opinion. You just have a mutual fund account and just buy all mutual funds and just do admiralships. Now, why would you buy a Vanguard ETF versus a Vanguard mutual fund? Well, there's a couple of reasons why you might. Number one, you don't qualify for Admiral shares because the amount that you're buying is too small. So you may buy a Vanguard ETF, which gets Admiral share pricing. And if you buy a Vanguard ETF through Vanguard's brokerage services, you don't pay any commission, so you get a lower fee. So that makes sense. The other reason it might make sense to buy an ETF is if the mutual fund had a redemption in it, a redemption feature where there's a fee to buy it, or maybe a fee to sell it. And I think there's still some Vanguard funds there that they charge you a fee, maybe 0.5% to buy the mutual fund, or if you're going to redeem the fund, they're going to charge you to redeem the fund. And if you bought the ETF version of it, there's no fee. So again, it gets down to the cost. After that, with the Vanguard funds, there's really no different. Now, the other reason you might buy an ETF over a mutual fund is because the portfolio that you're trying to get is only delivered in the form of an ETF. Let's say the S&P 600 small cap value index. You decide after doing all your analysis that you really like that particular index to represent the small cap value portion of your portfolio. The problem is that the only way you can get that particular index is through an ETF. So you buy the ETF.
Yeah,
right?
I see. Mm-hmm.
And again, it's all, first of all, the first thing you have to look at is what portfolio, what package of stocks or bonds, what index am I trying to get exposure to? And then what are available, and then what are the delivery mechanisms of that portfolio? And if I can get it through a mutual fund just as cheaply as I can get it through an ETF, I'll just buy the mutual fund. If I can get it through an ETF, only through an ETF, well, you got to buy the ETF. If I can get it cheaper through the ETF than a mutual fund, then I buy the ETF. And so that's what you want to look at. There's one other consideration, and for Vanguard investors, it's not that important because I'll explain in a minute. But ETF portfolios on the equity side generally are more tax efficient than a mutual fund of the same thing. Let's call it an S&P 500. If you bought an S&P 500 index fund correctly, or you bought an S&P 500 ETF, the S&P 500 ETF is going to be a little bit more tax efficient, so you may want to put that in your taxable account. Now, it doesn't matter with Vanguard, because Vanguard is the same portfolio. You're getting the same thing. The tax treatment is the same across the board, so it doesn't matter. But let's say that if you're talking about another company, and you could either buy an ETF from this company or a mutual fund from this company, you probably, if it's going into a taxable account, all things being equal, want to use the ETF version of it because it's more tax efficient. Now that's only correct for stocks, a little bit for bonds. If you're doing commodities or anything else, which is a completely different discussion,
right.
You're gonna get hit with taxes anyway on the ETF, just like you would with a mutual fund.
Right.
So I hope that answers your question.
It does. Thank you very much. Appreciate it.
Yeah.
One more from the house. And Tony's ready too. And I have a quick one too.
Hey Rick, I'm Nick.
Okay,
Thanks
2
for
minutes
doing
each.
this.
Sure.
Thanks for doing this for us. Appreciate it.
Sure.
So a common theme here is also that beyond our interest in being bogleheads and being really serious about it, loving it, we can't somehow get it across to our wives. It's kind of a common.
You can do what?
We can't get it across to our wives.
Oh,
the point.
Okay. All right.
There is this particular fund called Vanguard Wellington Fund.
Okay, sure.
There are lots of good things about it. What can you tell us about that fund? What is it missing for a young family? Like, I've been reading that if they can do nothing else, the spouses, I mean, this is the fund they'll fall back onto. Like, this is the one thing you should leave for them. If you don't know anything else, just put all your money in Wellington and let it ride.
Okay, well, I haven't heard that philosophy, but I mean, to me, to me, my response to that is that if you're going to buy one fund and just leave it and not do anything with it, it would either be, well, I could use two funds, but one total stock market fund would be the one fund I would buy. I mean, I actually buy that over the total global fund because the total U.S. stock market fund is so much cheaper than the VT, which is the total global. So, I mean, did she say this, or are you saying?
No, I read it on Bogleheads.
Well, don't believe everything you read on Bogleheads.
Okay. So that answers my question.
Wellington Fund is a good fund. It's an actively managed fund, but it's very low cost. It has low turnover. There's going to be some tax distributions in a taxable account. It's a value tilted fund, so you're getting a more value exposure. And that's the big reason why it has outperformed in the past. I'm not going to say it's not a good fund. I mean, it's a low cost fund, which is important. I just don't I'm as I described the church, being in the church, okay, so the people who are talking about Wellington are in the church, but they're in the last row.
Okay, get it.
We're closer to the altar.
Okay, get
They're in
it.
the last row.
That's a very good analogy. Thank you.
Hey, you made it in. So.
Thanks. See you at the front someday.
Okay, thank you.
So could I ask if maybe just let's go a couple minutes past 11:30 if I could
That's
say
fine. Sure,
2 minutes for Tony and then 2 minutes for me and we'll.
Okay, that sounds good. Sure.
Yeah, I had a strategy question just on the bond side. So I wanted to hear your compare and contrast of your kind of standard bond portfolio versus Bill Bernstein's. I've kind of
Well, Bill's been wrong for years, but we can go forward.
I know he has. I know.
I'm posting that on the forum.
I have firsthand experience because I read his books in the early 2000s and went that way with the bonds, and I've been there still. And I'm looking at this thing, and this is probably the moment that I shouldn't change if I do change. But anyway, it is pretty radical for at least from a Bernstein reader to hear a portfolio with a high yield component for bonds, for example. So maybe you talk to those points a few ways.
Well, let me first describe my bond portfolio. Okay. So we have the U.S. bond market, of which is mostly made up of investment grade bonds, which is mostly made up of treasuries and agency bonds and mortgages. So that's the bond market in the U.S. And so 60%, the middle I call it, 60% of my portfolio is total bond market. There's two parts of the U.S. bond market that are not in the total bond market, even though it's called total bond market. There's two sectors that are not in there. One sector is TIPS, Treasury Inflation Protected Securities. So you need to have your own separate component of TIPS. And I did a little work on this, and I came up with about a 20% allocation to TIPS. I'm not going to get into the details of it, but that's what it came up with. So 60% total bond, 20% TIPS. And the other 20% is a portion of the bond market that is not represented, and that's high yield bonds. Now, there's an inefficiency. I don't want to get into the inefficiencies of the market because, the markets are generally efficient. But the double B rated portion of the high yield bond market is an interesting portion of the market because the size of the investment grade market is this big, and you got all these institutions that have to buy investment grade, and as soon as a company falls from triple B to double B, they have to sell it. And what that does is it creates a lot of selling pressure. It ends up the double B portion of the market, the high yield bond market, is actually been a very nice place to be. It's not far below investment grade, and you're getting a good yield better than investment grade in the double B, single B category, which is the only place Vanguard invests their high yield bond fund. So if you look at the risk return relationship of high yield Vanguard high yield bonds, now, I'm not talking about D grade bonds or C grade bonds, which act a whole lot like equity. Right. I'm talking about this slice of it. I've actually found it to be a very nice complement to the 60, 20, 20% here. And strangely enough, the correlations between high yield bonds and TIPS can go negative at times. So you find yourself doing this rebalancing between high yield and TIPS on occasion. And it's worked out. So the portfolio that I have looks much more like the bond market than the total bond market index fund, which is not the bond market. And so it's a strategic allocation that I've held for 15 years, with the exception of the TIPS. The TIPS came in a little later because we didn't have a TIPS fund, I think, until 2001 or 2002. But when it came in, I added that. So I used to have 80% total bond market, 20% high yield, and then when TIPS came out, I went to 60, 20, 20. And that's where I've been for 12 years. And it's done very well. So that's my belief. Now, the duration of this fund is maybe 5 years, on average, 5 years. And what I tell people about the duration of your bond fund, different than Bill, because Bill's a market timer. He's trying to time the bond market. He's been wrong for years. So I said, Bill, I don't understand why you're doing this. And he admits he's wrong. But anyway, I said, if a retiree has got a lifespan of 30 years, and there's, he's not going to die next year or the year after, what harm is there in doing an intermediate term duration? Yeah, okay, so interest rates go down, interest rates go up. Yeah, so maybe the bond fund will fluctuate some. But the amount of income that you're getting from an intermediate term fund is so much higher than it is from a short-term fund that the opportunity cost that you give up by going short-term is too large for me, for a retiree, because the duration of your retirement is years off. So you, in my belief, and everybody's, again, this is strategy. Okay, the philosophy is the same. We're going to buy all low cost, but the strategy for me is I'm willing to accept a little bit more volatility in a client's portfolio for the 2% extra income that an intermediate term portfolio would give me over a short term portfolio, and it's worked out. Now, people like Bill or Larry would say your bond portfolio needs to be absolutely safe. And you don't want things like high yield in there because high yield tends to fluctuate some like equity. My answer to them is, so on the equity side, are you going to take out utility stocks? Because utility stocks tend to act like bonds. So if you're going to take out bonds that tend to act a little bit like stocks, then on the stock side, you need to take out stocks that tend to act a little bit like bonds. And the answer is, well, no, they don't do that. So it's like, well, I'm okay with having some stocks that act a little bit like bonds, and I'm okay with having some bonds that act a little bit like stocks, because I'm looking at the whole portfolio. And that's my strategy. I don't know if that answered your question, but that's where we are. You can do whatever you want. You can keep following Bill. In fact, I recommend it because, right, as soon as you change, Bill's going to be right.
Exactly. We know how that works. Did I get it?
Oh, yeah,
okay.
you got it.
So, all right. So now, is it even in today's low interest environment? You still feel that the marginal benefit of that little more duration? I guess he'd be more like 2-3 years. You're more like 4 or 5 years.
Yeah. Okay, it's not much.
Yeah, it's not that much. Yeah, right. So we're kind of. But the high yield is actually a bigger philosophical gap, I would say, and you're taking advantage of a particular phenomena within this high yield market, the inefficiencies around the junk bond threshold.
Yeah, I mean, I'm not investing in junk bonds that act a whole lot like equity. I'm trying to. They're going to act a little bit like equity, like they did in 2008. Finally, went down, but I was reallocating money back into high yield. I mean,
right, as it went down, right.
Yeah, because the tips in the treasuries in 2008 went way up. So it gave me an opportunity to do some rebalancing on the bond side. You got to look at the bond portfolio as the whole portfolio and how it's working together. Now, at times they're going to be highly correlated, not only on the downside but on the upside as well, and so it doesn't work out. But if you look at the performance of my bond portfolio in 2008, even though I had high yield in it, it was maybe flat. I mean, it wasn't down because the other, part of the portfolio went up. Right. So if you believe in the philosophy of you want to have something in your portfolio that stabilizes stocks, my portfolio still stabilized stocks.
I see. Sure. Right.
Maybe it didn't stabilize it as much as a two-year duration treasury portfolio did, but I mean, it still did what it was supposed to do.
Although in the case of Larry, I guess Larry would have had a little higher percentage of the treasuries, intermediate treasuries, and tried to get a negative correlation out of his bonds. Is that in his
okay. So Larry gets into the minutia of it, and like we can go into Larry's mistakes as well as his. There's whole thing about commodities and being negatively correlated with stocks and all of that, where he got absolutely wiped out with that idea.
Oh, interesting.
I mean, I read Larry's stuff. I like Larry. I give him a lot of respect, and he's trying very hard. But it gets back to that blueberry pie.
Yeah. No, I agree. As soon as you mentioned as soon as you said the word blueberry pie, I knew what you meant. It's really interesting. You didn't have to explain it.
I mean, let's keep it simple. Let's keep it simple. Let's not try to get too smart about this stuff.
Blueberry pie is kind of fun if you're a Boglehead.
All right, good. I'll move on. All right, thanks.
Okay, well, I want to kind of wind it down with this. This has been fabulous Saturday morning for everybody in this room, I think, and so we're all grateful.
We're so
to you.
sick.
Yeah, it is kind of we're probably the only people in the Durham, North Carolina area who dive down into such minutia and love it.
Good. Well, I'm glad to hear it.
Yeah, so I just would like to kind of wind it down with one final question, which is, I think we're all kind of on board in this room with Boglehead style strategy, and we've read your books, philosophy. I'm sorry, yeah, and we've read your books and other books. But kind of as Nahal was kind of alluding to, how to convince or advise your family if something were to happen to you, where do they go? Or kind of along those lines, I'm thinking, how can we educate our loved ones, our family, our friends? Do you have a recommended book? Now, and you're not allowed to recommend a Ferri book. So,
I think the book to recommend is...
you can recommend a Ferri book as extra credit. But if there was one book that we had to share with a loved one that we wanted to encourage them to adopt a reasonable philosophy, what would that be?
Well, I always like The Coffee House Investor.
Oh, right.
Bill's book. Yeah, I mean, in fact, the very first version of it, the little green book, I thought was outstanding. It talks to you like, I don't want to deal with this stuff. I'm really not interested in this stuff. I'd rather be out hiking and biking and doing fun stuff than dealing with this crap. I mean, if you're that type of investor, who are just not interested, and how do you speak to somebody about it? You start out by saying, you and I have something in common. We both hate this stuff. But we have to deal with it. So I'm going to tell you how to deal with it the easy way. And then he gets into his coffee house ideas. So I think Bill hit the nail on the head with that. So that's the book I would recommend. And if you can get a hold of the little green book, I think it's even better than the bigger version of it. We authors tend to think that when we come out with a second edition of a book, we need to make it thicker and bigger, and I think but anyway, The Coffee House Investor would be my pick.
That's wonderful you mentioned that. I actually give that book out to pretty much everybody I meet, because I find it's the easiest one for a newbie that nails the key points. But, however, that said, I have not done the same with the green book. I've never read the green version, and I'm going to see if I can find a used version online, because
it's just a small little pocket thing that I think it's shorter than his other book. I have them both, but I think it's the best. His little thing about, outfox the box, I don't know if you remember that portion of the book.
Okay, yeah.
He has the boxes and he says, okay, you go into a bank and you bring $10,000 into a bank, and they say, okay, we're going to put it in one of these 10 boxes, and this box is going to give you $13,000, and this box is going to give you $11,000, and this box is going to give you $10,000, this one 9, 8, 7, 6, and so forth. And then he said, when you come back,
Why am I thinking that was Scott Burns? Maybe I'm getting mixed up.
No, that was Bill. That was Bill Schulteis.
Okay, Bill Schulteis. Okay, it was.
The outfox the box, and I thought that was a great example of this whole idea. And look, yeah, you can do better. You can pick that box that has $13,000 in it, but more than likely you're not. More than likely you're going to pick the box that has much less in it. So would you be willing to pick the box that has $12,000? Knowing there's a box out there that has 13 out of those 10 boxes, would you be willing to pick the box that has would you be willing to take $12,000 rather than try to find that one box or two boxes that have 13,000? And the answer is, because if you don't, the other boxes have much less. And the answer is, well, of course you would. Okay, well, if that's the way you believe, then you should be using index funds. And I think that's a kind of an interesting way of explaining it to people who have never really thought about it before. So, I mean, that's the book I would recommend.
That's a great choice. And of your own books, do you have a favorite for a newbie?
You know, this is why I'm trying to write that other book. I think my first book's Serious Money, the one that's free, even though it's dated, it goes back to 1999, but it speaks to the kind of the coffee house idea in a very simple way. And the best thing about that book is it's free. So there you go.
All right. Good one.
Yeah, and then this other book I'm trying to write, The Education of an Index Investor, is trying to speak to that audience as well. We'll see how it comes out. So,
good.
That's it.
Well, Rick, is there any final words for us Durham Boglehead investors? Or?
Yeah, I mean, go to a Boglehead conference if you've never been to one before. I mean, Jack's going to be 85 this year, so I don't know how many more years he's got left. If you get a chance, it's only right up the road for you. It's not that far down the road, I should say.
Compared to Texans, it's up the road. But
yeah, I mean, we got, I think it's sold out this year, but sold out very quickly. And we got 250 people. But if you've never been to one, it's really, you talk about geekishness, like you guys get together on Sunday. Okay, imagine 3 days of this. It's really kind of neat to go to one. So if you can, maybe they're going to announce a few openings this year. Again, you're very close by. So
about a 6.5 hour drive.
Well, in Texas, that's close.
Yeah. Well, that's great advice. I'm gonna try to. Actually, I can unplug the power here, and I'm just gonna show you a little view of the people.
Hello, people.
Works. Maybe if you all want to give
Hey.
a round of applause.
Thank you for coming and spending your Saturday with me.
Yeah. So thanks, Rick, and really appreciate it, and hope you have a wonderful weekend.
And listen, one more thing is that I do these things with the hope of getting the word out. So feel free to put your video online. Make a Boglehead post about it. Talk about it, because it's just sharing knowledge is all it is. And I think that what we did today helps to add to that body of knowledge. So don't hesitate to exploit it.
Well, that sounds great. So I guess I might talk with these guys here and find out if they have any objections, because I wouldn't do that without everybody's permission, since they're kind of recorded here.
Sure,
but,
I understand.
We really appreciate that. So.
Okay, well, thank you, everyone.
All right. Thanks, Ray. Yeah. Bye-bye.
Bye-bye.